for this month's edition of the November Monthly Market Monitor. My name is Adam Stone. I'm the SVP of Investment Services for Corporate Central and President of Corporate Central's Balance Sheet Optimization QSO Quantify. So I'm going to go through in chronological order kind of some of the big economic releases that came out since our last iteration of this webinar last month. So first up, retail sales came in at up 0.4% in September, which was significantly above the 0.1% gain in August, and also just slightly above what the market had been expecting. If you look at retail sales and exclude food services, auto dealers, building materials, and gas stations, which is the figure that they used when they were calculating GDP, that was up by 0.7%, which was the highest in 3 months. So the graph here shows the month-over-month change. So obviously some big distortion in these numbers. You'll see a lot of that in these graphs on the 2020, 2021, as the economy and the market were reacting to all the various impacts from the pandemic, but it has flattened out a little bit. But the last reading last month was quite high. If you look at it by sector, miscellaneous store retailers, clothing, health and personal care, food and beverage, general merchandise, non-store retailers, and sporting goods, hobby, musical instruments, and bookstores all saw a gain on a month-over-month basis, while electronic and appliance stores and furniture stores saw a decline, as well as gas stations, though that might be largely due to the drop in gas prices recently. Next up, building permits in the U.S. were down 3.1% to a seasonally adjusted rate of 1.425 million in September, and that's down from 1.428 million the prior month. So again, you look at 2020, you saw a big drop in building permits, as there were very few, if any, permits getting filed during the initial stages of the pandemic. That again skyrocketed back up into 2021, 22. Saw kind of a big boom in the permit sector of the housing market. That has kind of steadily declined since then, and hovering around the 1.5 million annual pace now for the last couple of years. And building permits are kind of a leading indicator of the housing market. They're approvals given by local jurisdictions before any new building construction can start. And they break it down into 2 sectors: those with 5 or more units, your multifamily units. Those were down 9.2% to a 405,000 annual rate. And the single family units were down 0.4% to a 963,000 annual rate. And permits did drop in 3 out of the 4 regions of the country, led by over a 12% drop in the Northeast, whereas the West was the only region that saw an increase of almost 9%. Sticking with the housing sector, housing starts dropped by 0.5% from the prior month to an annual rate of 1.354 million units in September, which was right around where the market had been expecting, but was down from a big 7.8% increase that we saw in August. And housing starts are kind of the next logical step after building permits. So you follow your building permits, then you start construction, and then later again comes the new home sales. So this is kind of the interim step. Again, broken down by 5+ units were down 4.5%, and single family starts were up 2.7%. And 3 out of the 4 regions of the country saw a drop, with quite significant drops in housing starts in the Midwest of about 9%, and in the West of over 10%, whereas huge increase in the Northeast of almost 58%. So now we get into actual home sales. After you file your permit and start construction, then you have your new and existing home sales, which are kind of the endpoints of the housing market metrics that come in around the same time of the month every month. So existing home sales were down 1% to a seasonally adjusted rate of 3.84 million in September, and that's after a 2% drop that we saw in August. This report also has data related to sales prices. So the median existing home sales fell for the third straight month to $404,500, down from $414,200 the prior month. And 1.39 million homes were for sale in September, which is the most since October of 2020. So we are seeing quite significant inventory of existing home sales stay in the market and not get sold. New home sales increased 4.1% to a seasonally adjusted rate of 738,000 in September, which was the highest since May of the following year and came after 709,000 reading in August. Consensus had been for 720,000, so it came in quite a bit above the estimate in September. Looking at it by region, Midwest saw a decline, whereas the South and the Northeast saw increases, with the Northeast again seeing a big 21, almost 22% increase. And this has data related to pricing as well. So median price of a new house was 426,000 roughly, while the average was 501,000, and compared to 426,000. So no change really in the median price, but the average price did drop from 515,000 down to 501,000. And there are 470,000 new homes listed for sale, which at the current sales pace would equate to about 7.6 months of supply, which is historically quite elevated. So we're seeing quite a bit of homes for sale, both in the existing home category and the new home category as well. Uh, New orders for manufactured durable goods dropped by $2.2 billion, which is a 0.8% drop, down to 284.8 billion in September after a 0.8% drop in August. That did compare with the market expecting a 1% drop, so a little bit better than expected. Look at it by sector, transportation equipment, capital goods, machinery, and computer and electronics all saw declines. And the key metric that is used in calculation for GDP is the orders for non-defense capital goods, excluding aircraft. That was up by 0.5% in September after increasing by 0.1% in August. Another key thing to monitor as far as the housing market is the home price index. So the S&P CoreLogic Case-Shiller 20 City Home Price Index is one of the key metrics that I like to look at when talking about home prices, because it measures 20 key cities around the country. That was up 5.2% on a year-over-year basis in August, which is while it was up 5%, it's the slowest level of year-over-year increase in 10 months, and followed a 5.9% increase in July. So if you look at some big cities, New York, Las Vegas, Chicago were all up big, over 7%, and Portland and Denver were trailing in the 20 city index at just under 1%. So all 20 cities are showing a year-over-year increase. But if you look at historically on this graph, it was pretty steady around a 5% year-over-year increase in the housing sector. Again, COVID really distorted that. Saw huge 20% year-over-year increases for a period of about 2 years. Did drop off quite significantly in 2023. Actually saw a brief period of decline in home prices, but then it climbed back up steadily in 2024, and we'll see if we're settling back into that 5% year-over-year increase, or if this downward trend we've seen since the beginning of the year will continue. GDP showed the U.S. economy expanded at a 2.8% rate in the third quarter, came in slightly below 3% expectations, and a 3% reading in the second quarter. This was the first of a couple advanced estimates. There'll be another GDP estimate coming out in a couple weeks, and then the final third quarter GDP number will be released in December. So worth keeping an eye on to see if GDP for the third quarter is revised one way or the other. Looking at it by sector, saw pretty healthy increases in consumer spending. including both consumption of goods and services, as well as government spending. Big increases in contributions to GDP from equipment and both exports and imports, though we did see declines in private inventories and non-residential investment and residential investment that detracted from some of the GDP growth during the quarter. Looking at core PCE, which is what the Fed likes to look at, they often refer to it as their preferred measure of inflation. Looking at that in a month-over-month basis, it was up by 0.3% from the prior month. This reading was from September. So that was the highest in 5 months and followed a 0.2% increase the prior month. Looking at it on a year-over-year or annualized basis, the PCE remained at a 2.7% increase in September, which was just slightly above the 2.6% that had been expected. So the graph here shows month-over-month increases. So looking at it again, historically, 2015 to 2020 kind of fluctuated between 0 and 0.2% on a month-over-month basis. But then as inflation really skyrocketed over 2021, 22, early 23, you see instead of the range of 0 to 0.2, it was more of a range of 0.2 up to 0.6, showing that you annualize those monthly figures and you get CPI or inflation numbers of 2 to 3 times what had been expected, which is what the CPI numbers showed as well. Personal income rose by 0.3% to an annualized rate of just under $25 trillion in September, which was about what the market had been expecting and picked up from a 0.2% increase that we saw the prior month. Looking at it by sector, compensation of employees increased by 0.5%, and personal income receipts on assets, which is typically all income outside of traditional compensation, that was up by 0.2%, or that actually decreased, excuse me, by 0.2%. And then the flip side to personal income, you have your money coming in. This is the money going out. Personal spending was up by 0.5% from the prior month and to an annual rate of just over $20 trillion in September. That followed an upwardly revised 0.3% increase the prior month and was above the market expectations, which were about a 0.4% increase. Looking at it by sector, spending for goods was up by 0.5%, including an increase for durable goods of 0.8% and non-durable goods of 0.4%. And spending for services was up by 0.5%. So the main categories for personal spending, goods and services, both up 0.5%. Now, looking at the employment picture, the U.S. economy added only 12,000 jobs in October, which was below the prior month reading of 223,000, which itself had been downwardly revised. And the forecast for October had been 113,000, so that 12,000 number was significantly weaker than the market had been expecting. And it was the lowest since December of 2020 when 243,000 jobs were lost. But again, that number is a little skewed. It's likely that some of this low employment we saw could have been caused by the hurricanes, but the BLS, which is the department that administers the non-farm payrolls number, was unable to quantify the effect that it may have. So interesting to follow this, see if it picks back up the following month or if that's the beginning of a trend. Looking at it by sector, healthcare and government both saw healthy 52,000 and 40,000 respectively gains in payrolls, whereas temporary help services, manufacturing, transportation equipment, manufacturing specifically, all were down, though the BLS did say that a big drop could have been due to the Boeing strike, which is over now and may reverse itself in the following reading. The other half of the employment picture is the unemployment rate. That was at 4.1% in October, remained unchanged from what was a 3-month low the prior month. It was right around where the market had been expecting, so no significant surprise there. And the number of people unemployed was also unchanged, hovering right around 7 million. So Permanent job losers rose slightly to 1.8 million, and the temporary unemployment people were little changed at 846,000. And also long-term unemployment was also relatively unchanged at 1.6 million, and the labor force participation rate fell very slightly to 62.6%. People collecting their initial jobless claims fell by 3,000 to 221,000, which was right around where the market had been expecting, although was well below averages that we had seen in recent months. If you look at this graph, in previous months, it had been above 250, almost 260,000. So the 221,000 is improved from the last few months. And initial jobless claims are somewhat of a leading indicator, perhaps the number of people who filed for unemployment benefits for the first time. And then second half of that would be your continuing unemployment claims. So not just the people filing for the first time, but those that need to continue to file ongoing jobless claims. That was increased to 1.89 million in the week ended October 26, which is the highest in almost 3 years, and compared to the 1.85 million from the prior period and a forecast of 1.88 million, so slightly above forecasts. So you see the continuing jobless claims had trended down 2022 to kind of mid 2022, early 2023, started trending back up, and may have plateaued a little bit. Recent uptake, we'll see if that's a trend or an anomaly when the next reading comes out. So the Fed met on November 7th and announced, to no one's surprise, that they decided to cut their Fed funds target rate by 25 basis points, which means the Fed target rate is now a range of 4.5 to 4.75%. If you recall, at their last meeting before this one had been held in September, and they made a big 50 basis point cut then. But leading up to this meeting, there was almost a 99% certainty that the market was pricing in a 25 basis point cut. So no big surprises either direction there. The Fed did exactly what everyone was expecting them to do. At the meeting, Chair Powell and other policymakers did reiterate their previous message and something they've been saying over and over again, that they're going to carefully assess all the incoming data, the evolving outlook, the balance of risk, etc. So they're very keen on assessing long-term trends in data and not making any knee-jerk reactions to any weekly, monthly, or even quarterly data points coming in. They want to make sure the long-term data leads evidence to a long-term trend before they make any decisions. So they announced that they have not made up their mind of what they're going to do the next meeting or the one after that, which is pretty standard for Fed speak. During the press conference, Chairman Powell said that, like I mentioned, the Fed is not on any preset course and are going to continue to make their decision on a meeting by meeting basis. Powell did say regarding the impact of the presidential election, he said it's going to have no effect on policy decisions in the near term, and he's not going to speculate what the future government policies will do or what the Fed's reaction to that will be. So we're very curious to keep an eye on the kind of relationship between the Federal Reserve and the incoming president as time goes on. The Fed dot plot here, all the yellow dots you see are the different Fed presidents forecasting their expectations for future Fed funds rate over the next several years. The green line is the median of the consensus among all the policymakers. The other line to pay attention to is the white line, which shows the Fed funds futures implied rate. So whereas the green line is the median of all the individual members of the Fed stating their belief of where the Fed funds rate will be. The white line is where the market is placing their bets on what the rate's going to be. So you can see the market is expecting higher future short-term rates than perhaps the Fed governors themselves are projecting. If you recall, there was a long period last year where the market was expecting more cuts than the Fed was forecasting, and now we kind of flipped that around, and the market is now forecasting fewer cuts than the Fed. Another report came out last week. Consumer sentiment was up, as measured by the University of Michigan Consumer Sentiment Index, increased to 73 in November, which was the highest in 7 months, and up from just over 70 reading in October. Worth noting that this data was collected and compiled before the election, so any changes in consumer sentiment resulting from the election is not captured in this number. So we're curious to see the next consumer sentiment report and if there are any changes to it. And again, this index measures individuals' prospects for their own financial situation, their view on the economy over the near term, and also their view on the economy over the long term. So you see it historically, 2015 to early 2020 had been hovering around, 85 to 97 range. Pandemic really dropped that off down to below 75 and even dropped further in 2022 to below 55. It's starting to elevate a little bit, but not back to kind of the historical average that we had seen about a decade ago. And then just released this morning were inflation numbers as measured by the Consumer Price Index, or CPI. It showed that on a year-over-year basis, CPI was up 2.6% in October. That's up from a 2.4% reading we saw last month, but the market had been expecting it to increase to 2.6%, so it came in right in line with market expectations. Nonetheless, it was the first increase we've seen in that index in 7 months. Looking at it on a month-over-month basis, it was up 0.2%, also in line with what the market was expecting. And the core inflation rate was up 3.3% year over year and 0.3% month over month, also largely in line with what the market was expecting. So no big surprises in the inflation number that came out this morning. The market had kind of been expecting it to go up slightly on a year-over-year basis, and it did. Very keen to see where this goes from here. Again, looking historically, pandemic caused it to go extremely high, 8.5%, had been trending down for a couple of years. That trend is possibly reversing now, or maybe it's a temporary blip. Time will tell. Looking at it by sector, energy prices were down almost 5%. Gas prices really down over 12%, whereas shelter and food costs were both up. But vehicle cost, as measured by both new vehicles and used vehicles, were both down. So kind of a mixed bag when you look at it by sector. But gas prices really leading the charge. They're down 12%. So those were the major economic releases that came out. Looking at a historical chart of some treasury rates, you see the 2-year treasury depicted here over the last 10 years. So the notable low interest rate period of 2020, 2021. Then you saw the Fed raise the short-term rates by 500 basis points, with treasuries quickly following suit, the 2-year up to about 5%. And during several months between 2022, 23, and 24 had been starting to taper down back to below 4%, almost 3.5%. Just a few months ago. But as the market started to come to terms with the possibility the Fed is not cutting as much as they maybe had anticipated, we've seen the Treasury rates start to climb back up and climbed even more in the last week or so. Similar trend when you look at the 10-year. Again, 10-year often cited as a leading indicator for mortgage rates as well. Had been trending down during the early parts of 2024, quickly reversing again with Fed expectations reversing course as well, and back up to 4.42 this morning when I pulled this. Similar for the 30-year, up to 4.58 this morning, up from below 4% just a few months ago, not even that long ago. So significant increase in both short-term and longer-term rates in the recent weeks. That is all I had to share with everyone today. Appreciate all of your time. I'll open it up, see if anyone has questions, and didn't see any come through the chat. So with that being said, again, thanks for your time, and I hope you all enjoy the rest of your week. Thank you.